Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of February 23rd, 2025. And in this week's episode, we are going to talk about when it is safe to sell a call. As you know, calls are one of the most dangerous types of options to sell. And I'm going to talk you through a situation where not only is it safe to sell the call, but they can turbocharge your returns while you hold the stock. But before we get to that, I want to give a shout out to our Discord, link in the description below. Hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week's content, I'm going to talk about when it is safe to sell a call. And if you've watched any of our past episodes, you will know that I have called out that selling a call is by far the most dangerous type of option selling that you can engage in. And there is a safe time in which you can do that. And when that time is when it is what is known as a covered call. That means that you already have shares of the underlying that you are selling a call against. Now, as a quick refresher, remember, when you sell a call, the person that is purchasing the call has the right but not the obligation to buy those shares from you at the specified strike price. So, for example, if you sell a $100 strike in Apple to someone, they are allowed to knock on your door and say, hey, I want to buy my 100 shares of Apple for $100 from you. Because that is what that contract represents. Doesn't matter if Apple is trading at $150 a share or $95 a share, you are obligated to sell that to that person that holds the option at that $100 strike. Now, that person will pay you a premium for that coupon, which does have an expiration. And so you as the call seller are looking for that option to either expire worthless or you're okay to sell at that price should you end up getting assigned. So what is the case there? If you hold the shares, why do you want to sell that premium versus waiting for the price to go higher than that $100 strike and then go ahead and unload the shares? Well, the reason you might do that is because you don't know necessarily when the price is going to reach that strike. Also, you might not want to get rid of the shares. Maybe you have a very long-term vision for the particular company that you're holding, and you don't want to ever lose your shares, and you're not really into the swing trading. You don't want to try to, dump your shares when it's higher to buy them back when it's lower. Because maybe you don't have time to watch it. Maybe you're not comfortable to watch it. You said, you know what, I'd rather just hold on to these shares. Maybe the particular underlying pays a dividend. And if you are out of the shares, you might not get the dividend. And so you don't want to not be holding the shares when a dividend comes up just because you might have missed the swing re-entry or things like that. And so where this is the lowest risk for you is if you are a shareholder and you have the shares to cover the contract and you're not really trying to swing trade it. You're not really trying to buy low, sell high. You're just looking to kind of build your position and hold these in your portfolio over a longer period of time. So the example I want to talk about today is a particular position in my portfolio, and I've done this for different strikes, different quantities, but the part that I'm going to zero in on is I have 200 shares of a stock VRT. Now that 200 shares will allow me to deal or sell 2 calls because each call contract represents 100 shares. I have 200, so I can do this for 2 contracts. And I'll talk you through how I used selling this call to really turbocharge the annual return for holding these shares versus, not selling that call premium. So let's jump over here to the chart that I have laid out. Now, I started this trade back in September of 24. Now, that particular time, I'll pull up the chart later on in this episode, but at that particular time, the stock was trading around $95. I was feeling that we were going to approach a double top around 108, 105, somewhere in there, and I was looking for a rejection and kind of going lower. So I wanted to sell a call because if I ended up getting assigned at 105, okay, great. I've made some money because my cost basis was less than $95, which is where the shares were trading when I started selling the call. And what ended up happening is it ended up going through my strike deeper into the money, but I didn't really want to just kind of give up and take those options into expiration and let them get pulled away from me. Because one thing I've learned over the years is the rate of early assignment is actually incredibly low. It is very, very rare to be early assigned when you have short calls. Now, does it happen? 100%. I have been assigned early, but it doesn't normally happen. So if you're not quite ready to get rid of your shares and you're in the money, you can close that position out a few days before expiration, roll it forward to the next month, collect more premium, and hope that the underlying is going to come back down below your strike. And you can kind of keep doing this month after month after month and get more and more premium. And the whole time you're basically getting paid to hold those shares. So let's talk a little bit about, what do I get from holding my 200 shares as far as a yield or a return on that without premium selling. So VRT pays a dividend. They've recently increased it, but if I look over the last 6 months, that average dividend is about 3 cents per share that they pay out. And so if I take when it was trading at $95 a share and I divide that 3 cents by $95 a share, it comes out, and then I multiply that out. Look at it monthly and then look at it and multiply it out for an annual yield. It's almost a 1% annual yield that I will collect simply by holding those shares and collecting that quarterly dividend. So not very much, but it's not zero. So you're kind of paid to hold the shares a little bit. Now, you can't really bank on that because they could cut the dividend. They might increase the dividend. The stock price might go up. And if the stock price goes up, but they don't change the dividend, the yield that you get on the dividend will actually go down because you divide the dividend divided by the price to get your yield. Now, if the stock price goes down, then your yield goes up. So it all can change over time. So, roughly, let's just consider this about a 1% return simply for holding the shares. So what can I do to kind of boost that return or turbocharge that return? That's where selling the covered call comes in because I can collect premium for selling a call and I don't have to give up the shares unless, of course, I'm assigned or called away early. And so on September 23rd, I went ahead and opened 2 contracts at $5.60 a piece or $560 each. I collected. So almost, a little over $1,100. Now, what I did was that ended up driving up and pushing through the strike, and I was actually in the money. However, I was able to roll and collect more premium. Now, you have to look at this chart in a little bit of a diagonal fashion because the very first month that you are now in the money, you're going to book a short-term loss on that. So that first set of options, I ended up closing out for $17.17. Now, that's more than I paid to initially sell them, but I turned around and then sold it for $19.47 for 1 month out. And that difference between $17.17 and $19.47, or a little over, $2, that was the premium I collected then on top of that. And you will always, always, always collect more premium if you keep your strike the same and you go out in time. The reason for that is because the extrinsic value or the value that is inherently in the option from the current trading price to the strike price is going to be there both on the one you're closing and the one you're opening. So it cancels each other out. So you can kind of throw the extrinsic value away, and the only thing you have to deal with is the difference in the extrinsic value. I said that backwards. So the extrinsic value is the value outside of the option, which is not based on the price. It's based on the time premium left in there. So the extrinsic value will always, always be more further out in time than it is at this exact moment. And that is the difference of the 1717 and 1947 is the little more than $2 of extrinsic value that I'm collecting. And then so in this particular example, come November 15th, it still wasn't below 105. I decided to roll out again. And again, I'm collecting the difference here of 17.20 to 19.20, or exactly $2. And then this just kind of keeps repeating. Now, the further in the money you are, the less extrinsic value there is. And so you could see the roll that I did in December was almost not a lot. It was about $1. Still $100, but not a ton. Not like that original $560 that I collected in September. And the other thing that you'll get is, even though you have these short-term losses along the way, your last trade will always be for closing out for $0. Now, that will be because it either expires worthless, or because somebody has called them away from you early and you don't pay anything to close it out. So your last trade will always be for $0. So even though in this first one you ended up, pulling in extra money and going in the short-term loss, you will 100% get it back by the time you make the last roll, either because it expires out of the money or because you're early assigned. So what do we have here? Let's add it all up. So February 11th, I rolled again to March. Now, come March, I might roll again, or maybe I'll get early assigned. Either way, I will close out for $0. And so if I add up all of these differences, I will have collected, assuming that this last roll is my last trade, I will have collected $427 from holding these 200 shares. And what does that actually mean? So if you divide that out by the number of shares that I have and the notional value, assume that notional value of that $95 or $19,000 notional value, divide out that 427 by that notional value, and you can see that this is a monthly yield of about 0.4%. Well, 0.4% monthly, you need to extrapolate that out to an annual yield. And that's roughly a 4.8% annual yield that I'm picking up simply by selling the calls. I've done nothing different. I'm still holding those 200 shares. I'm still collecting the dividend, but all I decided to do was go ahead and sell calls against my position. Now, should they get called away, it's okay, because the strike that I sold is above my cost basis. In this case, it was, more than $10 above my cost basis, because my cost basis was less than 95. And so what I have been able to do is, instead of sitting there on that capital collecting just a 1% annual yield, I have added 5% to that annual yield, collecting almost a 6% annual yield for holding these shares. And this is why I say there is very, very little risk, little to no risk on your end, right? The only real risk that you have is, you might get early assigned at 105 and the stock could be trading at $140, and, your risk is, oh, bummer, I missed out on, $30 of upside move, or whatever that difference is between 105 and where it is when you get early assigned. But I'm going to pull up the chart here in a minute. You'll see that while I was doing this stock went all the way up well above, $130, $140 a share. Nobody ever early assigned it to me. So I was able to just keep rolling, just keep collecting more premium, and kind of padding that yield for holding the shares and collecting the dividend along the way. So I mentioned we're going to talk about the chart. So let's go take a look at the chart that I have, and it'll show a little bit about where I entered, what I was doing, and thought process there. So this is the daily candles of VRT going back to late 2023. And you can see this stock really went on a tear all the way up to around May of 24. In May of 24, we kind of topped out around $109 and then really pulled back down here to about $60, $65. And then we kind of went on another tear. And this start of this first red box is where I sold that 105 call. Why did I sell that 105 call? Because this potentially could have been the beginning of a downside trend. And a downside trend, if we were really in it, would come up to that previous high and reject either off of that high or drop lower before it gets to that high. So on September 23rd, I sold a call that was $10 above where we were trading at. It was quite a bit of volatility. That's why I was able to collect that $560 per contract, which is right at the level that I thought we might reject off of and go lower, thus keeping all of that premium. But what ended up happening is we ended up punching through that level, kind of went above, went down, tested that level, and that level held now as support, and we went higher. And so that's why I said, you know what, I'm really not ready to get rid of my shares. Let me go ahead and keep rolling this for premium. And so each of these red boxes here is an additional time that I rolled, and I rolled to the next month, and I rolled to the next month. And I was always doing this roll when the amount of extrinsic premium was high. So volatility was high, it was close to expiration, and kind of push it out to the next month. And then sure enough, look what has happened. So this last red box is where we are now. And so the edge of this box is out in March 21st. That's where it expires. And we have now broken through and closed below this previous level of support, which was also previous resistance. And so from a price action standpoint, it is very likely that we are going to end up out of the money from this expiration, and I'll go ahead and expire it or let it go out worthless. Now, if we come and end up close to this 105 level again, I might actually get back in and keep rolling it. Don't know. But for what I want to talk about, just assume that last trade will always close out for zero, like I mentioned, because when you're done with this, you either get assigned, in which case you pay nothing to close and you collect the other money of the strike by selling at that price, or it expires absolutely worthless and you close it out for $0. So that last trade of being at zero is true kind of no matter how it ends. So if I jump back to the chart just to kind of reiterate here, the power that we've got dealing here is I have taken on no additional risk. There is no additional risk that I will lose more money. The only risk, if you want to call it, is that I won't get as much money as I could get if I get assigned early. But, that's a good risk to have. You make money or you don't make as much money as you could have made, but you still make money. Nobody ever gets in trouble for taking a profit. And so what this strategy allows you to do is if you are a long-term holder for a particular underlying and you have the shares to cover the call, you can sell call, collect premium to turbocharge your annual yield, boost that annual yield, make those shares work harder for you, collecting more money for you as time goes on. So that brings us to the end of this week's episode about when it is really safe to sell a call option. And that is when you have the shares to back up the call. So it is known as a covered call. And you want to sell that call at a strike price that's above your cost basis. So should you end up getting assigned, you're going to make a profit on that because you're selling above your cost basis. And the benefit here is you get to collect premium along the way. And don't think that just because the shares punch through your price and you're trading, it trades above your strike, that you're going to get assigned. It's very, very unlikely to be early assigned. Does it happen? Yeah, it happens. But it is it's much more rare than you think. And so what you can do is close out your position a few days before expiration and roll it to the next month. And you will always be able to do that to collect more premium. And so think of it like a quasi or pseudo dividend yield that you're picking up simply by holding the shares. And that's on top of whatever dividend that stock pays out, if it pays out a dividend. Because remember, you're the shareholder. So you get to collect the regular dividend over time because you own the shares. And this is just an extra dividend that's kind of a hidden dividend because it's not on paper, but you get that premium, and that premium divided by your notional value of the shares is your additional yield that you're picking up with this particular strategy. And it's definitely something that I have used for positions in my portfolio that I don't intend to swing trade, that I don't intend to sell with any sort of price target, but I'm holding on to them long term. So I'm expecting volatility over time in them, and we might go up, we might go down, but I don't want to spend time trying to figure out when to, buy low, sell high for these positions and kind of swing trade in and out, swing trade in and out. I want to set it and forget it. And so what I'd rather do is just roll that covered call forward month after month after month, collecting premium along the way and still holding the shares, still collecting the dividend. I'm never at risk of not getting the dividend because I never am without my shares. I keep them. If you're swing trading them, you run the risk of not holding the shares when the ex-dividend date comes along, because maybe the price isn't your optimum entry or exit price. So you might be missing out on a dividend should you try to swing trade along the way. Hopefully you were able to get some nugget of information out of this for you. Maybe this appeals to your trading style, maybe not. Either way, it is a little more information on different strategies that work for different people. So volatility in the market is really increasing, which is awesome, because from a premium selling standpoint, that's when things get interesting. That's when you can really find good extended volatilities to sell the premium, look for contraction. So whatever your trading style is, hopefully you're finding opportunities out there in the market, and hopefully it is trading in your favor. So good luck out there, and remember, think outside the block.